I know. Hi, everyone. Wendy here
It's
is laughing.
lunchtime, isn't it?
She's laughing because my stomach is over here growling. Bill Fairman and Wendy Sweet with
Hello.
Carolina Capital Management. Thank you so much for joining us live again today. By the way, our website is, what is it? CarolinaHardMoney.com. Don't forget to share, like, subscribe, all that good stuff as well.
Tell all your friends.
If you have any questions for our guests who I'm getting ready to introduce, you can put it in the chat box and we will certainly ask those questions time permitting because we always have a big list of questions ourselves.
That's right.
Here, I got one. I can't say one. Just kidding. We are pleased to have Sean Casterline of Tuscan Garden Partners with us today. Their business is all about something that is very important because that community is getting larger and larger.
That's right. We're getting ready to join it too. The senior living community. You're going to get there sooner than me.
Yeah,
but.
thanks. I was gonna say it's pretty close already.
That's right. We can see the light in the distance.
That's right. And these communities that Sean works with are in Florida. And by the way, they've gotten super high recognition for the great job they've done through this pandemic with focusing on the most vulnerable being the senior citizens.
Right.
So they've gotten really good ratings in the state of Florida. So without further ado,
I do.
Sean, I'm going to pop you onto the screen magically.
Right. Wow, there he is.
Guys, how are you? How you guys doing?
Thanks again for joining us.
Of course. Thanks for having
me. To get started with, let's talk about the rules and what's been going on with the pandemic.
Yeah, how'd you win the award? What'd you do that was special?
You know we did. We did absolutely nothing. We shut down all the communities, and that's how we get the award. But, with COVID, it's obviously seniors are the highest risk. So we decided, well before the state of Florida, to shut down our communities, keep our residents safe, focus on, not necessarily company growth, but the health and safety of our loved ones. And yeah, that's really kind of the reputation we're building. I mean, it comes to residents first, and if you build a great reputation and give great care, certainly the filling of the communities is secondary. So, it's been a trying time. We haven't grown like we thought we would, like we wanted to grow. But again, we're building a backlog because, as you guys jokingly said, COVID-19 is dangerous, but people are not stopping the aging process. So
we try.
Yeah, right. I've got things reserved for you guys, so you don't have to worry about that. But we're certainly again focused on our residents, and the growth will come when we're safely able to reopen.
So when you say you've shut them down, that doesn't mean you
send them all home.
You turn them all out. That just means that you don't have any unauthorized visitors and tours and that kind of thing, correct?
Yeah, we're also restricting our employees from going to hospitals as much as we can, unless there's a need. But yeah, certainly no loved ones coming in. Now, I will tell you recently in the last week or so, we've opened the communities for, family or loved ones to visit mom or dad, but behind a closed screen and minimal contact. So we're trying to keep our seniors, our families engaged as much as we can, but obviously doing it safely.
Right. That's awesome.
Yeah.
So what part of the states what part of the state? I know they're all located in Florida, as far as I know. What part of the state do you have these communities?
Well, as you guys can imagine, location, and all the retirees go to the coast. So we're primarily on the East Coast. We have one in Venice, Florida, which is south of Sarasota. And we also have two that are just north of Orlando. We're getting ready, Bill, as you know, to start construction in Columbia, South Carolina. We're our first one in the Southeast. We're certainly looking at other properties in Charleston and Greenville and some of the other fast-growing demographics throughout the Southeast. But we're Florida-centric. We'll always be Florida-based. It's obviously one of the destinations for retirees, much like Arizona, Texas, California. So that's where we're focused.
Right.
So these ones close to the coast, do you have your own boat docks and
You joke, but it's funny. Down in Venice, we're actually talking to a company. It's one of those boat rental companies, and we're talking to them about taking our residents out on pontoon boats.
Oh, neat.
Yeah, I mean, if you're going to be near the coast, you're going to be near the water. I mean, why not enjoy it and get our residents out of the communities? We obviously already have buses that take our residents to go shopping or go to the museum or movie theater. So certainly just be an extension of that. But it's a good call.
That's really neat.
Yeah.
So tell me about the different communities. I know we have different stages.
Right.
Some of them are assisted living. Some of them are independent living. I know you have some memory care operations. Give us a little insight onto the different communities and the ones that you're getting ready to open. What are they going to be?
Yeah. Well, and you and I were talking earlier, most people, when they think about senior living, they think nursing homes, right? I mean, mom or dad, go to a nursing home, but there's really 4 distinct subsections of senior living. So you have independent living is really kind of the front side of it. As a senior ages, they will either go into assisted living or memory care, or then again, skilled nursing. So there's really kind of 4 distinct areas. We think that independent living, assisted living, and memory care are kind of the sweet spot for the industry. Just from doing research early on, we realized that there's probably not a market in the entire state of Florida that has enough memory care.
Right.
So continuation of care really is independent living, assisted living, and memory care. The way we're building or developing our communities, we're building assisted living and memory care first, because the one thing we do realize from doing research in the industry is people won't move into independent living with the promise that assisted living and memory care are coming. So again, we're building that first. So when our independent living residents come in, they'll have that assurance that continuation of care will be there for them. And we are building them in 2 phases, just because of the size of these communities. But we're getting ready to go into construction for our independent living in Palm Coast, probably midsummer, and then Delray Beach, probably in the fall. So yeah, things are certainly moving for us.
How do the municipalities where you're looking at these properties, do they favor that type of construction? Is that something that they see as a need?
It depends, as you know, on the municipality, but we were told before we bought our Palm Coast property that 2 other developers had come in and the county was not, excited about their projects. In reality, what we found out was they were trying to encroach upon preserve. We had a great experience with our Palm Coast community. As you know, in South Florida, things can get very tough. With our Delray Beach project, we were very well accepted, very well embraced down there. And I think, for senior living, it's a different animal. If I'm going to go build a apartment complex in the middle of Delray Beach or Boca Raton, it's going to be very hard to get that project through. But there's just so much need in senior living right now. And again, this baby boomer generation is a massive generation, and you can't stop that train. And they realize there's unmet demand. So we've had pretty good success, all things considered.
Excellent. Well, I'm sorry, I keep talking. Do you have any questions?
So I understand, well, a lot of people don't understand really how the senior living, the development of senior living communities work. So I'm really interested in understanding, how do you choose to get into this kind of a business, and how do you finance? I mean, how does that work?
Well, and there's about 15 questions there. I'm gonna have to.
Good. We should be good then.
Yeah. I mean, the entitlement and permitting process. I mean, once you identify a property, you're looking at probably 18 months to 2 years to really get this thing shovel ready. The first thing we do is we do internal demographic studies. We want to make sure that the project's going to work, that there's unmet demand that needs to be filled in that marketplace. And then from there, we pay outside third parties to do demographic studies, and we start the construction process. But the biggest thing is with all different forms of real estate is finding areas where there's unmet demand. And fortunately for our business, because of this, this silver tsunami that's coming, there's very few markets that don't have demand, So, but as far as financing, we take in private investors. We have used what's called a Reg D 506C fund up to this point. You have to be accredited to invest with us, $50,000 minimums. And then once we've raised the equity, we will use typically 142D bonds. to finance the debt side. So, the good news is the biggest investors we've had on our bonds have been Nuveen, Oppenheimer, J.P. Morgan, a lot of the names that people see in their 401ks and on Wall Street. So that's primarily how we've done it. For Palm Coast, we're really looking at more traditional bank financing because there's so much kind of upheaval in the capital markets right now. So I think we're going to do a lower LTV, probably use somebody like KeyBank to finance that project. But you guys know, I mean, the development business, every project's different. Depends on economic cycles and conditions. But so far we've weathered some crazy times like you guys have.
Right. So how are you choosing your locations? You're in Florida now. You talked about going to Greenville, Charleston,
Right.
And Columbia, which are South Carolina locations. And we always say that North and South Carolina, we call them the halfback states because people come from the Northeast, they move down to Florida, they're tired of all the heat, and then they move halfway back and they kind of stay right in the Carolinas.
Yeah.
So what is it that makes you choose an area to build? What's attractive about that?
It's really the demographics. I mean, to answer the specific question about kind of branching up into South Carolina, we have a regional operations manager in our Winter Park office, and she oversees all of our Florida properties. So she spends time with the executive directors in those properties every week and every month to really, we think, manage these types of properties correctly. We want to have an operations manager, a regional operations manager, near that Columbia, South Carolina project. So, I mean, hey, you look at Greenville, it's one of the fastest growing cities in the entire country. Yeah. Charleston has a lot of folks moving there as well. There's certainly suburbs of Atlanta that a regional operations manager could cover. So that's the reason we're kind of grouping these things geographically. But as far as the projects themselves, it's all about unmet demand. And I tell you this, every project we've developed has been off market. Every property we've found. The first one we found in Venice was introduced to us by our construction company, Core Construction. Columbia, South Carolina, the property was actually an orphanage for 100 years. I'm not kidding you.
Wow.
We moved the orphanage, and our chief development officer was a South Carolina grad, University of South Carolina. So he still got connections in Columbia, and it came to us before it went to market. So the Delray Beach project we bought from another senior living development group who had two properties. They developed one, but they get all their funding from the Hunt brothers out in Texas. Oil prices collapsed. They're like, hey, we're not going to fund two. So it's just kind of a sidetrack story. But a lot of times in real estate, it's about finding the right properties, but also how you find them. They're not properties that have a for sale sign in the front yard,
And you're not just looking for land, you're looking for land that had a use previously?
No, I mean, not necessarily. I mean, we'll go through the entitlement and permitting process. I mean, in Venice, it was pretty much ready to go. We had to go through some processes, but Delray Beach was, shovel ready when we bought it. So it kind of depends case by case, what we're going to do or need to do.
Well, I find it interesting that you were using corporate bonds to fund one of your projects.
Yeah.
Right.
Now, obviously, with the upheaval in the capital markets, it's a little harder to do the corporate bonds right now. But
yeah,
I think going forward, banks are still going to be open-minded to development of senior living,
right,
versus a development of a mixed-use, project where you still have no idea how big your restaurants can be, if there's going to be any retail at all.
Right.
Those are pretty speculative, but we know good and well we're all getting older.
Yeah.
So,
hopefully.
Yeah, right. It's I would tell you guys this, just to add on to that, Bill, that the government is obviously subsidizing banks right now, right? I mean, you have a 10-year Treasury note that's yielding 0.65%. Banks can't make yield on that. There's no margin there. Right. So what we also decided to do is apply for HUD debt for our construction in Columbia. So we were originally planning on going under construction in June, and you're exactly right. With the upheaval in the capital markets, Nuveen, one of our bigger bond buyers, decided to step back. And so we decided, hey, look, let's go to the funding source for what's happening in the economy today. And HUD is still financing deals. They're good deals. They're long-term, non-recourse debt. The problem is it's a longer process to get that debt. So again, what we've ended up doing is just kind of juggling our projects. So we've moved Columbia from being now to probably late summer. Now we're putting Palm Coast Independent Living up on top of the stack. So yeah, you just have to kind of adjust during these crazy times, you know.
Have you had to make any adjustments to the people who are in your fund currently? And what I mean, in dividends that you may be paying out, anything like that? Have you had to make any adjustments during this time for them?
We have not. And I'll tell you why, because we committed to our investors many years ago that we're going to pay them 8% income. We paid out on a monthly basis. I know a lot of operators will joggle that number depending on profitability. And we just don't think, you know, from our perspective in this economy, people are looking for income. So to be able to provide them consistent income is a big benefit.
Sure.
We set aside reserves before we ever go under construction to be able to pay these. A lot of our developer fees or operational management fees for our communities. But no, we've been paying our distribution for 3.5 years now. And, you know, it's not going to go up when the economy is going to go, you know, good, but it's also not going to go down in this type of situation. So we haven't had to do anything. You know, we've also thought outside the box a little bit. I know I've talked to Bill about it, but we've set up a mezzanine debt fund for Columbia, South Carolina that doesn't have the equity kicker on the backside. It's just income. But it's a higher rate of income. And again, we realize that's what people want today. So, you know, we've again tried to think outside the box a little bit and we're able to pay those distributions.
Awesome.
Well, I have to say that the tortoise is always going to win the race.
Steady plodding.
And you have a lot more people interested in the tortoise when the markets are crazy.
Yeah.
Turbulent, as we say, right?
Yeah. Well, listen, most people feel like the stock market, you have no control anyway.
Right.
And it's the, you know, I guess the corporate stock people are the ones that are the only ones that make any money.
Unless you're a senator and you sell all your stuff when you know stuff's coming down the pike, right? Yeah. Oh, but I digress.
We'll move to a different subject.
There's a question that.
Oh.
Yeah.
Go ahead. Can you read it? I have my glasses on. I can't see that.
Can
far.
investors reinvest their monthly income back into your fund? You said you pay it out monthly. Do you let them reinvest it like compound, or how are you working that?
We actually do not. Once the capital stack is set, unfortunately, we can't continue to add capital to those projects. It's something we've kicked around. You know, one of our earlier funds, we did have a share class that just reinvested, and you didn't get income at the time, but we just had so few people that had interest in that share class, we decided to just pay the income. So, you know, one of the things, our fund is IRA eligible. So a lot of times what we'll do is once that distribution amount starts to build up, you know, transfer the cash back over to the original custodian, or maybe reinvest into more shares of ours, but we have to let it build up a little bit first.
Well, if you are interested in long-term versus the income piece of it through an IRA, that's a good way to attract investors, is to allow them to compound over time. So I mean, you have other communities, so it's something to think about on some of the other funds too.
Yeah, we're always thinking. I mean, we've got, you know, we've got our Reg A fund, Reg A Plus, that was approved by the SEC. So we're getting ready to launch that fund as well. Those are lower minimums. And I believe you will be able to reinvest in that fund, because the Reg A Plus is actually a public instrument. I mean, it really works like a mutual fund. So
right.
So yeah, let's talk about that a little bit more. So you have lower minimums. You don't have to be accredited, or you do?
You do not have to be accredited, but the limitation is you can only invest up to 10% of your entire net worth. So a little bit of a joggle there, but yeah, the $10,000 minimum for our fund pays 8% the same way, 50% of the upside on the backs, you know, as far as the equity gains on the real estate itself. But we actually just got our fund listed at Charles Schwab. So
oh, good.
Yeah, real big, obviously, feather in the cap to be able to work with other investment advisors and, you know, people who might want to be in some defensive real estate. So yeah, we're excited about it. We haven't fully launched it yet, but we're, you know, trying to get the networks built up before we do. So,
well, getting back to the 10% of your net worth is the max you can invest in any one Reg A Plus fund. That's actually kind of gets to the core of what we all in our mastermind group, all of our different fund managers, we do not want people to put a big chunk of their net worth into one fund anyway.
Right.
We're always preaching, to diversify throughout the different real estate spaces.
Right.
Because, I mean, the whole reason you're in a fund in the first place is because there's, protection in numbers, safety in numbers, if you will.
Right.
And if you're, you may be diversified in a fund, but if you put too much of your net worth into one fund, you're still doing the same thing. So,
yeah. And
go ahead.
Well, I mean, I was just going to add on to that. I mean, you guys have had investors like I have. I mean, investors are young. Maybe they have a $750,000 net worth. They want to give us $400,000. It's like, it's just not, it's
Right.
not appropriate. It's not, it's not good practice. And we really are fiduciaries with our investors' monies, right? We have to do the right thing
Absolutely.
appropriately. So, yeah, we certainly have to give some financial guidance on that side.
So, was it a arduous process doing the Reg A Plus?
That's a big word. I'm impressed, Bill.
Computer
I had to look
5
it up
points.
first.
It was a long process. And actually, I'll tell you, I think it's getting easier though, Bill. I mean, we first did our first pass to the SEC, lasted about 6 months, and we're like, this is just, it wasn't really us. It was that the Reg A was so new, we didn't understand the landscape. So we
Right.
went out for about a year, and then we went back in. And even after that, it took us about a year, to get that fund set up. And there's so many question marks about it still, I think, but it does seem to be a pretty good distribution fund that we can use to really expand our network and open up to smaller investors and really build this thing. So,
And I really believe, especially now with the way things are, that the smaller investor, there's more people out there that are going to want to invest in funds like yours.
Yep.
that offer that kind of opportunity, and they're not accredited. They can dabble in the stock market, but who wants to do that? It's just, it's scary.
Yeah, it really is. I mean, and the fact is, the commercial real estate has always been kind of the domain for big billionaires and big hedge funds, and why would it be available to mom and pop investors? For the same reason that these endowments and foundations invest in it.
John, how much time do you spend talking to your investors about what the business is like? How deep do you get into that to explain to them how all of that works?
As a broad blanket, right? So we do quarterly webinars with our investors. Larry and I Larry's our founding partner. We just did our annual State of the Union address to all of our investors. We do a lot of email blasts. Hey, here's what's going on. We're juggling a couple properties, keep them informed. And on our website, TuscanInvestor.com, our investors can actually log in and see their investment. I mean, we actually use CrowdStreet as the backside of that website. But we try to be very hands-on, but like every pool of investors, you're gonna have some guys that are very significant development guys that really understand it, want to dig deep. So we can do that. I mean, I've had times where I've brought Bill Johnston, our CIO, in to really digest and dissect numbers with some sophisticated investors. But I think mostly, Wendy, it's case by case. We try to touch our investors, keep them in the loop, because we don't want to be that group that says, hey, give me your money and we'll see you in 5 years. We want them to know what their investment's doing.
Right.
We're going to encourage them to refer other investors and maybe add more money. So we do that.
Well, I did want to ask you about the equity kicker in some of these funds, and how does your investor realize that equity piece? Is it when you sell a property or refinance it, or how does that work?
You just hit them both, right? So it's either, the logical thing. So next question.
He's not just a pretty face.
Yeah, no. But for us, we build a community, we fill it up, we season it for a year, then we sell it off. There's a profit component there. Or if we just refinance the community, we still have to value that asset, right? So at that point, we split profits on the backside with our investors. Our real goal is to, hey, let's build up a number of these communities and then sell them off in a bigger package. So I think maybe refinancing them would make more sense in a 3 to 5 year time frame. Sell them off as a bigger package probably makes more sense in a 10 to 20 year time frame. If we do a good job.
So that said, and I've got distracted now. I've forgotten what that stupid question was. Again, there's no stupid
You
questions.
got a room for him?
Well, I
They've
think
got memory care.
Well, I think of the original question. Let me ask you this one: Is there, as an investor, is there a way that if you're an investor in the community, you can get some sort of a discount if you end up having to move into one?
Great question. And my answer is, if you invest enough with us, dividends will pay your room rate. So
That's a great way to look at it, right?
All right, good job. Good way to work around that one.
Yeah, right. But all joking aside, all of our investors do go to the top of our waiting list. So in senior living, obviously, you want to build it and have a great reputation and build a 6 to 18 month waiting list. And if that does happen, all of our investors go to the top of the waiting list for them or their loved ones if they should ever need care. So there's a benefit,
So when you do, and this is a question that's in the chat, you're paying monthly dividends basically,
and then when you sell
or interest payments. So when you do sell the property, are they now getting all their money back plus the kicker? So are they all getting a redemption from that fund, and then now they have an opportunity to get into another? Is that kind of how it works when you sell the property?
That's exactly right. Yeah. So obviously, if we build a community for, say, just call it $50 million, part of that's equity, part of that's debt. When we sell or refinance the community, we pay that $50 million back, and then whatever's left over gets split between the Tuscan Gardens Development Group and our investors. That's how that profit would come into play. But they do get their original principal back first.
Yeah. Excellent. All right. So we're getting kind of close here to the end. How can people get in touch with you about your different fund options? How do you want them to contact you?
The easiest way to get in touch with me would just be go through the Tuscan Investor website. So if you go to the Tuscan Investor website, you put in your email address, certainly we'll send you blasts and you'll have my contact information from there as well. You're also welcome to email me direct, sean.casterline@tuscangardens.com. And that's, again, my direct email. So happy to talk to anybody about, what we're doing with our brand.
Excellent. So how is it being in Florida? Not everybody's locked down, right? You guys can still go out and do stuff now.
Restaurants are open, man. It's crazy. It really is. I think I told you I was actually up in the Blue Ridge last week. I was up there for about 2 weeks. I tried to come up to your part of the world. It seems a lot nicer this time of year,
And, well, it has been a little bit.
It's been chilly, yeah.
It's beautiful up there. We loved it.
Oh, good.
Yeah, love it up there.
It's been really weird. It was a really warm summer, and I had to cover some
Warm
of my
winter is what he meant to say.
Yeah.
That memory care is getting it.
Yeah, I need to get into that care quick. But it was a really warm winter, and 2 days ago I had to cover my new vegetable plants from frost.
Yeah, in May.
And usually here in May it feels like summer.
Yeah.
So
yeah, things are shifting a little bit on us.
Yeah.
Absolutely. Sean, thank you so much for joining us.
All right, guys, I appreciate your time.
And I hope that we'll talk soon. I'm sure we will see each other shortly on another.
We will, because we're all
on
friends,
another
right?
webinar.
Yeah.
All right. So, folks, thank you so much for joining us. Again, any information that you'd like about us is carolinahardmoney.com. And don't forget to like, share, subscribe, all that good stuff. Have a great day. See you at 1:00.